depreciated under the income forecast method. So upfront, not many taxpayers will be using this tax form. However, this tax form does apply to taxpayers who may use the income forecast method of depreciation as described in Internal Revenue Code section 167G. So, for example, this might apply to certain properties that have qualities where the income is hard to predict at the beginning of the life. It's not really dependent on the physical condition of that specific property. So this depreciation specifically applies to things like motion picture films, videotapes, sound recordings, copyrights, books, and patents. And all of these are relatively speculative assets where you have to take a depreciation based on forecasted income, and then as a result, you're either overly predicting the amount of income, or you're lowballing it. So whatever you forecast and depreciate against, you're probably going to have to go back and revisit the actual depreciation, then make adjustments. And as those adjustments impact your tax liability, you'll also have to calculate interest that would have accrued either in the case of a tax refund or in taxes that you owe to the Internal Revenue Service. So as we walk through this scenario, just recognize that there are a lot of off-form calculations that you're going to have to complete. So for every time you estimate a change in tax liability, you might have to go back and then apply the quarterly interest schedule, which you can find on the IRS website. If you go to irs.gov and type in quarterly interest payments in the search bar, you'll find this page that talks about quarterly interest rates, how the IRS calculates interest rates, or specifically how the Treasury Department calculates interest rates. And then they have historical rates that go back to 2017. And if you need to go back further, there are additional rates in the form instructions themselves. So in this scenario, we're representing John Doe. He's our hero. He is filing this form as an individual. He may or may not have to file this form with his personal income tax return. We'll figure that out as we move through the form instructions. So just understand that these numbers are simply numbers for illustrative purposes. They probably are not rooted in any realistic scenario. So these are numbers that we've placed in here so you can visualize how this would work. The vast majority of the work is going to be completed off form. So let's go ahead and begin. At the very top of the form, we have to determine the recomputation year. So in this year, we're in tax year 2023, and we're recomputing income for the 2022 tax year. So the beginning and the end date of that tax year go at the top of the form. We'll enter the taxpayer's information as outlined here to include an address, identifying number, and then the applicable box to show what type of taxpayer we're discussing. So John Doe is an individual. If he were filing this with his income tax return, then the address information would be unnecessary. So just think, if you have to file this separately from your tax return, then you'll need to put the address. If you don't need to file it separately and you can attach it to your tax return, then you'll do that. You don't need to complete the address field. Now, if you were an owner of a pass-through entity, or if you had an ownership interest, this could be an S corporation, it could be a partnership, and that pass-through entity depreciated one or more properties related to this interest calculation, then you would enter the name and the employer identification number of that entity. If you need to, you would attach a schedule. This might apply if you had multiple entities all reporting their income adjustments. So I guess if you were Steven Spielberg, this would be a much more comprehensive and complicated form than if you were, an indie music producer that had a couple of albums out. So in this case, we're going to go to line 1, but before we do, I want to explain each of these columns here. So the recomputation year, that's the year that's impacted by these changes in the interest calculation. So we're looking at this for 2022, but we're also going to see what prior years might have been impacted. And again, this is based on the changes in depreciation as recalculated. So the recomputation year might be 2022. We would actually enter each tax year prior to that in which we depreciated the property or any other tax return that was affected by these years. So in this scenario, we're going to go back to 2020 and 2021. But if we needed to go back to 2018 or 2019, we could simply attach additional versions of this Form 8866 and attach them to the back. However, for column C, you're only going to complete this for one form. So when it talks about totals, if you're using one form, you can simply total columns A and B, come up with the sum over here. Otherwise, you're going to be entering the sum of all columns A and B across all of these forms. So in line 1, we're talking about the taxable income or loss for the prior years shown on the actual tax return. Now this is before the net operating loss, before any capital loss carrybacks, any other of those adjustments. But if you did file Form 8866 for a prior year, you would instead enter the line 3 amount for that most recent recomputation year. So for example, if we had done this for the 2021 tax year, this number would simply be the line 3 amount from that year's adjusted taxable income. So we would take that number, we would slide it up here and enter it as such. So in this year, we're going to keep everything the same. We'll just assume that John Doe has been making a very consistent income, $80,000 of taxable income every single year. And then in line 2, we're going to make an adjustment to that taxable income. And that adjustment will reflect the difference between, deep breath, A, the depreciation deducted under the income forecast method based on estimated future income, and then B, the depreciation allowable under the income forecast method based on actual income, right? So let's imagine that we had a depreciation schedule based on certain income forecast, and then we had to lower that depreciation because the income came in lower than expected, or if we had to raise that depreciation because the income was higher than expected. We would make those adjustments. We would make those adjustments offline, but we would enter those adjustments on line 2 because those are the reflections on net income. So in line 3, we're simply going to add lines 1 and 2 and come up with the adjusted taxable income. This is for look-back purposes. So in the recomputation year, our income went up to $90,000. Same with 2021. In 2020, though, there was a negative adjustment. let's just imagine that income exploded in 2021 and kept going in 2022. So, as a result, we lowered the adjustment. In 2020 it was lower than we expected. In 2021 it rebounded and it was higher. So now our adjusted taxable income is $70,000 for the 2020 year, and it's $90,000 for 2021. So now we would have to use the tax rates that were in effect for those years to reflect that. So for individuals, that might be tax whatever was in the tax tables. You would reduce that tax bill by any allowable credits as long as they're not refundable credits. So no earned income credit, no child tax credit. You would also not take into account any credit carrybacks to the prior year in computing that amount. So except for the carrybacks that either resulted from or were adjusted by the redetermined depreciation for look-back purposes. So again, we're simply going to adjust the tax bill. And so in this case, our tax bill went to $15,000 in the recomputation year. For the prior years, it went $9,000 in 2020 and $15,000 in 2021. The actual tax liability in both years, this would be historical information that you grab from the prior tax return or the prior Form 8866, the line 4 amount, if you had done a recomputation. So the original was $12,000, which means in 2020 there was a decrease in the tax of $3,000. In 2021, that became an increase of $3,000. So that line 6 amount will reflect either an increase or a decrease in tax liability. For pass-through entities, you would have to basically multiply the line 2 amount, this adjustment to taxable income, by tax rates depending on which year. So a pass-through entity which was more than 50% held by individuals or other pass-through entities in 2018 and later, that tax rate would be 37%. For all other taxpayers, like a corporation or something that was not a pass-through entity, or a pass-through entity that was not held more than 50% by individuals or other pass-through entities, that rate would be 21%, and that would be subject to the change in corporation tax rates starting in 2018. So in this case, we are going to calculate the interest due on either the increase or the decrease, and that's based on from the due date of the, not including extensions, of the recomputation year or the date the return was actually filed in. So that whichever was the earliest of that date, you're going to calculate the applicable interest rates, again from the quarterly interest rates on the IRS website, and this interest is compounded on a daily basis. So it's a good thing we have tax preparation software that can run those numbers, because the manual calculation for several years worth of interest accumulation would probably be pretty difficult for most individuals to calculate. So I went ahead and did that, and for 2020 we ended up with a tax decrease or an interest decrease of $300. That means that the IRS was sitting on $300 that should have been in John Doe's pocket. However, in 2021, John Doe owes a little bit more, so he also owes $200 in interest. On lines 7 and 8, we're going to carry the net result of each of those columns over to the column C. So for line 7, we have a $200 interest increase. followed by a decrease of interest of $300. So you subtract those. If line 8 is greater than line 7, you're going to put the difference in line 9, and that's the amount of interest that you expect the IRS to refund to you. If it were the other way around and we had $300 in line 2 and we had $200 in line 8, then this $100 difference would be the amount of interest that the taxpayer owes. So if you have a number in line 10, you would not need to complete any of the mailing address fields. You would not need to sign this form. You would simply attach your completed Form 8866 to your income tax return, and then you would also have to include the additional amount. So for corporations other than S-corps, you could deduct that amount as interest expense for the tax year in which you paid that tax or incurred it. For individuals or pass-through entities, this interest is not tax deductible. So you simply would just pay the interest with your tax bill. However, in John Doe's situation, he actually was expecting a refund. So in this case, he would file this separately. He would complete the address field up at the top of the form. He, and if he were married, his wife would both sign right here. His tax preparer would also need to sign, as well as complete their information field, as you can see here. And then individuals would mail their completed form to the Department of Treasury, the IRS office up in Philadelphia. All other taxpayers would send this to the Cincinnati IRS office. So that's all we have for this tax form. We do cover this a little bit more extensively in our article, which you can find the link to in the show notes. You can also go to the website directly. Simply go to teachmepersonalfinance.com, type in IRS Form 8866, and our article should appear. If you like our tax articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. I'll attach any links to articles we've written on forms and schedules, either addressed in this video or in the article itself. I'll attach those to this to the show notes here. But if you have any questions, comments, please don't hesitate to hit me up by sending me a quick note in the comments section. So if you like this, please share with your friends and family or whoever you think might be interested in this. And if you have any questions, please reach out. Thank you very much and have a great day.